Before we begin, a quick and important disclaimer. The information presented in this video series is for educational and entertainment purposes only. Family law, asset division, real estate, taxation, and financial planning are highly complex fields that vary drastically by state, local jurisdiction, and individual circumstance. This content does not constitute formal legal, financial, investment, or tax advice, nor does it establish an attorney-client relationship. Viewers must conduct their own thorough due diligence and consult with qualified, licensed professionals, such as family law attorneys, certified financial planners, and certified public accountants, before making any decisions regarding matrimonial dissolution or financial restructuring during economic downturns. When the fabric of the American economy begins to fray, the conventional wisdom surrounding relationships, stability, and independence undergoes a radical and often terrifying transformation. In a thriving economic climate, when the gross domestic product is climbing, unemployment is low, and the housing market is booming, the path toward ending an unhappy marriage follows a relatively predictable trajectory. Couples sell the marital home, split the accumulated equity, divide their expanding retirement accounts, and transition into separate households to rebuild their lives. But when a recession hits, the entire landscape changes. The traditional rules of family law clash violently with macroeconomic instability, creating a high-stakes environment where a single misstep can permanently derail your financial future for decades to come. Consider a striking paradox rooted in historical trends. Logic would dictate that during times of severe economic stress, when job losses mount, inflation erodes purchasing power, and financial arguments peak, divorce rates would naturally skyrocket. After all, financial strain is consistently cited as one of the primary catalysts for marital breakdown. Yet, historical data from major American economic contractions, most notably the Great Recession of 2008, reveals the exact opposite phenomenon. During the darkest months of that financial crisis, overall divorce filings across the United States actually plummeted. This did not happen because couples suddenly found harmony or resolved their deep-seated issues. It occurred because the sheer cost of securing legal independence became an unattainable luxury. This reality introduces a silent and deeply distressing concept known as marital lock-in. Imagine a husband and wife living in a major American metropolitan area. The marriage has been emotionally dead for years, and both parties recognize that a separation is the only viable path forward. However, the year is 2009, and the macroeconomic environment has just decimated their lives. The suburban home they purchased for $400,000 is now valued at $320,000. While their outstanding mortgage balance stands at $360,000. They are entirely underwater, trapped with $40,000 of negative equity. Simultaneously, their retirement portfolios have shrunk by 35%, and credit lines have completely frozen as banks tighten lending standards. In this scenario, a physical and legal separation becomes practically impossible. They cannot sell the home because they cannot afford to pay the bank the difference at the closing table. Neither spouse can buy out the other's share because neither can qualify for a new mortgage under strict recessionary lending guidelines. If they file for divorce, they are not fighting over how to divide wealth, they are fighting over who is forced to absorb the toxic debt. As a result, thousands of couples across the country are forced to become what sociologists classify as recession roommates. They are legally married individuals who cannot stand the sight of one another, forced to live under the same roof, dividing the refrigerator with labels, sleeping in separate bedrooms, and crossing paths in icy silence simply because the financial penalty of breaking up is more devastating than the psychological toll of staying together. This structural lockdown creates a compressed reservoir of marital discontent that historical trends show eventually erupts the moment the broader economy begins to stabilize. But for those who cannot wait, or for those who find themselves pushed into the legal system during a period of market contraction, the tactical decisions required to navigate a split mutate entirely. The strategies that work during an economic boom can lead to absolute insolvency during a recession. Every single pillar of the divorce journey, from asset valuation and property division to spousal support and child custody arrangements, is fundamentally altered by shifting market forces. Take, for instance, the highly volatile nature of asset valuation during a recession. In a stable market, valuing a family business, a stock portfolio, or a piece of real estate is a straightforward exercise. But when the market is fluctuating wildly, the timing of your valuation date can completely alter your financial outcome. Case studies from past recessions highlight situations where a marital asset was valued at the beginning of a legal proceeding, only for its real-world worth to drop by half by the time the final judgment was signed months later. One spouse is left with a rapidly depreciating asset, while the other walks away with a fixed cash payout based on an outdated, inflated valuation. The calculation of spousal maintenance and child support also becomes a legal minefield when the job market softens. In typical economic environments, support obligations are determined based on a steady, multi-year average of earned income. However, when corporate layoffs accelerate, bonuses disappear, and businesses face sudden revenue drops, the family court system struggles to keep pace with reality. Courts are forced to distinguish between voluntary underemployment, where a spouse intentionally reduces their income to avoid paying support, and involuntary underemployment caused by a legitimate macroeconomic downturn. An individual who is laid off from a high-paying corporate position may find themselves locked into a support order based on an income they no longer possess, accumulating massive legal arrears while they struggle to secure employment in a depressed job market. Conversely, a dependent spouse may find that a fixed monthly support payment is no longer sufficient to cover the escalating costs of basic necessities in an inflationary recessionary environment. This deep dive masterclass series is specifically engineered to solve these exact problems for the American audience navigating these turbulent waters today. The old advice from friends, family, or generic online articles is wholly inadequate for the unique challenges of the current macroeconomic climate. You cannot afford to approach a marital transition using a playbook written for a bull market. The goal of this 10-part comprehensive guide is to provide you with the precise analytical tools, historical insights, and strategic frameworks necessary to comprehend how economic shifts redefine family law. Throughout this masterclass, we will systematically break down the hidden mechanics of a recession-era divorce. We will examine how to accurately value and divide assets when markets are contracting, how to structure flexible support agreements that protect both parties from sudden income volatility, and how to negotiate custody schedules when career paths and employment demands are shifting. We will explore case studies of how courts handle negative equity, how to protect retirement funds from being liquidated at the absolute bottom of a market cycle, and how to identify and counter bad faith financial maneuvers when transparency drops during an economic crisis. By analyzing these potential outcomes with clinical objectivity, you will gain the clarity required to eliminate fear, minimize catastrophic legal expenses, and make highly informed decisions that protect your long-term stability and your family's future. The rules of the journey have fundamentally changed, and this series will give you the map to navigate it safely. To truly understand how an economic downturn reshapes the divorce journey, we must dissect the single largest asset held by the vast majority of American households, the primary residence. In a stable or growing economic climate, the marital home acts as a reliable wealth engine. Property values steadily appreciate, equity builds, and when a marriage dissolves, the liquidation or division of that asset is a relatively straightforward mathematical exercise. The property is put on the market, a buyer is secured, the existing mortgage is paid off, and the remaining cash proceeds are split according to a negotiated agreement or a court order. In a recessionary environment, however, this entire paradigm is turned upside down. The family home ceases to be an asset and rapidly transforms into a financial anchor that can trap both parties in a cycle of litigation and long-term instability. Let us look at a highly realistic scenario in the current year of 2026. Consider a couple named Mark and Jessica, who reside in a major suburban market outside of Dallas, Texas. They purchased their home a few years ago during a market peak, taking out a substantial mortgage based on their dual incomes. Now, in 2026, the macroeconomic landscape has shifted. Local industries are experiencing corporate restructuring, tech and manufacturing firms are announcing widespread layoffs, and consumer confidence has dropped significantly. Mark and Jessica have reached a point where their marriage is no longer viable, and they decide to file for divorce. They assume they can simply sell the house, divide the money, and move into separate apartments. But as they enter the family court system, they run headfirst into the brutal reality of a recession-ravaged real estate market. The first major complication Mark and Jessica encounter is the phenomenon of the valuation gap. In a normal economy, a real estate appraisal provides a stable baseline value that remains accurate for months. In a contracting economy, real estate values can experience rapid downward pressure from month to month. Suppose Mark and Jessica hire an independent appraiser in January 2026, who values the home at $600,000. Based on this number, they begin negotiating a settlement. Jessica wants to keep the house to maintain stability for their children, So she agrees to buy out Mark's share of the equity. They calculate the net equity based on that $600,000 figure. However, because the legal system moves slowly, the final divorce decree is not ready for signature until June. During those 6 months, the local real estate market contracts sharply due to rising unemployment and high prevailing interest rates. Similar homes in their neighborhood are now selling for $520,000. If Jessica signs the original agreement, she is legally bound to pay Mark a payout based on an inflated, non-existent valuation, instantly absorbing an $80,000 loss on paper the moment the ink dries. Historical trends indicate that this valuation lag is one of the most common ways a dependent spouse inadvertently destroys their financial future during a recession. Even if Mark and Jessica recognize this valuation gap and attempt to adjust for it, they immediately face the massive hurdle of recessionary credit tightening. To execute a proper house buyout, the spouse staying in the home must remove the departing spouse's name from the existing mortgage. Lenders do not allow you to simply scratch a name off a contract. The remaining spouse must completely refinance the property under their sole name, using only their individual income. In 2026, under tight credit conditions, financial institutions are incredibly risk-averse. The bank reviews Jessica's single income and notes the broader economic instability. Because her income alone cannot satisfy the strict debt-to-income ratios required by modern underwriting standards, her application for a refinance is flatly denied. Furthermore, even if she did qualify, the interest rate available in a recessionary environment might be significantly higher than the historically low rate the couple locked in together years prior. Jessica is trapped in a position where she cannot legally fulfill the buyout requirements, meaning Mark's name remains tied to the debt. This leaves Mark in a dangerous situation. He cannot qualify for a new mortgage to buy his own place because his debt-to-income ratio is maxed out by the old marital home, and if Jessica suffers a job loss or misses a mortgage payment, Mark's credit score will be severely damaged. This leads us directly to an even more severe potential outcome: the negative equity trap. Imagine if Mark and Jessica look at the market data and realize their home is completely underwater, meaning they owe $500,000 on the mortgage, but the property is now worth only $450,000. In a healthy economy, selling the home clears the slate. In a recession, selling this underwater home means Mark and Jessica must collectively bring $50,000 in cash to the closing table just to pay off the bank and hand the keys to a buyer. For an average family facing job insecurity, that amount of liquid cash is non-existent. Case studies from past economic contractions show that when couples are faced with negative equity, the family court cannot easily divide the property. Instead of dividing wealth, the court is forced to allocate debt. The legal battle shifts from who gets the profits to who is forced to pay the monthly shortfall on a depreciated asset. Because neither selling at a loss nor refinancing is possible, many couples are forced into a legally sanctioned deferred sale agreement. The court orders that the property remain in both names, allowing one spouse to live there with the children for a set number of years until the market potentially recovers. While this looks compassionate on paper, the real-world execution is fraught with conflict. Mark moves into a small, expensive rental apartment while remaining legally responsible for a primary mortgage on a house he no longer occupies. If the roof leaks or the HVAC system fails, requiring a $10,000 repair, the fighting restarts. Mark argues he should not pay for repairs on a house he does not live in, while Jessica argues it is a joint asset that must be maintained. The structural stress of the macroeconomy forces these individuals into prolonged, toxic financial relationships long after their emotional marriage has ended. Another hidden danger during a recession is the temptation to utilize equity offsets. To avoid selling the home or dealing with the bank, Mark might agree to let Jessica keep the house and all its perceived equity, and in exchange, Mark takes the entirety of his corporate retirement portfolio, equal to the supposed value of the house equity. In a market downturn, this is an incredibly uneven trade that heavily favors the spouse taking the financial portfolio. The retirement account consists of diversified stocks and fractional business investments that, while currently low in value due to the recession, are highly liquid and historically poised to rebound quickly when the broader market recovers. The real estate asset, conversely, is illiquid, expensive to maintain, and weighed down by property taxes and insurance premiums. Jessica is left asset-rich but entirely cash-poor, holding a heavy real estate burden she cannot afford on a single income, while Mark holds a nimble, tax-advantaged portfolio that will compound in value over the next decade. These real estate dynamics clearly demonstrate that a recession alters the fundamental utility of property division in family law. It strips away the financial safety net that traditional divorces rely on, turning the American dream of homeownership into a complex legal liability. It forces couples to weigh the psychological cost of remaining legally or physically entangled against the absolute certainty of financial insolvency. But the real estate crisis is merely the first domino to fall when the macroeconomy contracts. While managing an underwater mortgage or an unrefinanceable loan is a massive hurdle, an even more complex and deceptive trap is quietly developing within the broader financial portfolios, corporate structures, and hidden balance sheets of modern American households. What happens when the assets you are tasked with dividing are not tangible pieces of real estate, but volatile stock options that have plunged in value, private business valuations that have completely collapsed on paper, or hidden debts that one spouse is actively trying to camouflage before the market hits absolute bottom? In the next part of this masterclass, we are going to expose the hidden strategies of recessionary asset division, including the exact mechanisms of the portfolio evaluation trap, and how to identify when an asset is being artificially deflated to skew the final settlement. When we move past physical real estate and enter the realm of liquid investment portfolios, retirement accounts, and corporate equity packages, the potential outcomes of a recessionary divorce become even more distorted. In the current economic environment of 2026, many professionals receive a significant portion of their compensation not in traditional base salary, but in complex equity structures such as stock options, restricted stock units, or performance-based shares. During a bull market, tracking and dividing these assets is relatively linear because values are steadily climbing. But during a major macroeconomic contraction, these equity packages can experience severe paper losses, turning into a high-stakes tactical battleground where the selection of valuation dates and division methods can alter a family's financial trajectory for decades. Imagine an executive scenario in the year 2026 involving a corporate professional named David and his spouse, Sarah. David works for a major technology firm that has seen its stock price contract by 45% due to high interest rates and reduced enterprise spending. David holds thousands of unvested restricted stock units that were awarded during a market peak. As they navigate their divorce, David argues that these unvested shares are currently worthless because the current market price is far below the initial grant price, or because they may never vest if corporate layoffs continue to accelerate. If Sarah accepts this narrative and agrees to a settlement where David retains all equity rights while she takes a fixed cash payout from their remaining liquid savings based on this deflated value, she is falling directly into the portfolio evaluation trap. Historical trends show that markets eventually cycle back upward. When the macroeconomy stabilizes and the company's stock recovers, David's equity package will regain its compounding power, while Sarah's fixed cash sum remains static and exposed to the eroding effects of recessionary inflation. To counter this specific vulnerability, sophisticated family law practitioners look to past case studies and systematically advise against assigning fixed dollar values to volatile equity assets during a downturn. Instead, they look toward a step-by-step process known as an in-kind division, often governed by a specialized court order like a domestic relations order or a constructive trust. This process avoids assigning an arbitrary cash value to the stock on a specific day in 2026. Instead, it divides the actual number of shares or options proportionally between the parties. By implementing an in-kind division, both David and Sarah assume an equal share of the market risk and the potential upside. If the stock drops further, they share the loss equally. When the market eventually rebounds, both parties benefit from the recovery. This approach removes the speculative element from the legal proceeding, ensuring that neither spouse is unjustly penalized or artificially enriched by the temporary timing of the market bottom. The complexity amplifies exponentially when the primary asset of the marriage is not a publicly traded stock, but a privately owned family business, a partnership, or a professional practice. Valuing a private enterprise during an economic crisis requires an incredibly disciplined approach to forensic accounting. Forensic appraisers typically rely on three core methodologies: the asset-based approach, the market approach, and the income approach. During a recession, the income approach, which frequently utilizes the discounted cash flow method, becomes highly susceptible to manipulation and distortion. This method calculates the current value of a business by projecting its future net cash flows and discounting them back to the present day, using a specific capitalization rate that reflects the perceived risk of the industry. In a contracting economy, a business owner spouse can easily utilize the surrounding financial chaos, as a cover to paint a catastrophic picture of the company's future viability. Let us look at a detailed case study of a private logistics and distribution company in 2026. The owner of the business can intentionally alter normal operations to make the company look financially distressed on paper. They might choose to delay invoicing major clients until after the divorce is finalized, accelerate the purchasing of expensive raw materials or inventory, or write off solid, collectible accounts receivable as bad debt. On the standard profit and loss statements presented to the family court, the company's net income will appear to be in a steep, unrecoverable decline. When the independent appraiser reviews these intentionally suppressed financials, they are forced to adjust their valuation models. Because the broader economy is in a recession, the appraiser will also increase the capitalization rate to account for the elevated macroeconomic risk. When a higher risk rate is applied to an artificially suppressed net income stream, the resulting mathematical valuation of the business drops dramatically. The non-owner spouse, feeling the financial pressure of the recession and wanting to avoid endless litigation expenses, is often tempted to settle for a minimal lump sum payout based on this manufactured low valuation. However, once the final divorce decree is signed, the business owner simply resumes standard operations, sends out the delayed invoices, collects the revenue, and watches the true value of the enterprise surge back to its baseline. Uncovering this specific type of artificial deflation requires a meticulous, step-by-step forensic audit of the business's operational data. A forensic accountant cannot simply rely on tax returns or high-level financial summaries provided by the business owner. They must dive deep into the general ledgers, review day-to-day bank deposits, cross-reference vendor contracts, and compare the business's performance against industry-specific benchmarks for 2026. They must track the historical cash flow patterns over a multi-year period to determine whether the sudden drop in profitability is a legitimate reflection of the recession or a calculated legal strategy designed to minimize the marital estate. Case studies reveal that business owners who attempt this strategy almost always leave an anomalous trail, such as a sudden shift in profit margins that does not align with their direct competitors, or an unprecedented spike in discretionary business expenses that perfectly correlates with the date the divorce was filed. Beyond the manipulation of business valuations, economic downturns also witness a significant rise in debt camouflage. In an environment where asset values are shrinking, a spouse looking to protect their wealth may attempt to introduce artificial or inflated liabilities into the marital balance sheet to offset their legitimate assets. For example, they might produce a hastily drafted promissory note claiming that the marital estate owes a massive, interest-bearing debt to a close personal friend or a family member for a past loan that was never previously disclosed. Alternatively, they might utilize personal margin accounts secured by their investment portfolios, drawing down large sums of cash to purchase untraceable assets or paying off fabricated expenses. If the court accepts these liabilities as valid marital debt, the net value of the entire marital estate shrinks, directly reducing the final payout received by the other spouse. Navigating these intricate asset valuation traps requires an exceptional level of diligence, emotional control, and tactical patience. The financial maneuvers executed during a recession are specifically designed to exploit the fear, exhaustion, and financial vulnerability of a spouse who is desperate to exit a broken marriage. However, uncovering hidden assets and auditing deflated business valuations is only half of the financial challenge. When the macroeconomy contracts, the baseline income streams that sustain families can evaporate overnight, completely upending the legal structures that govern ongoing support. How do you protect yourself when a spouse's reported income drops to zero just as alimony and child support are being calculated? What happens when a court orders support based on past earnings that are no longer mathematically possible to achieve in the current job market? In the next part of this masterclass, we will confront the highly volatile mechanics of support modification, career instability, and income volatility during an economic crisis. When the macroeconomic foundation cracks, the financial streams that once seemed rock solid can evaporate in a matter of weeks, fundamentally destabilizing the mechanisms used to calculate and enforce child support and alimony. In a standard economic climate, family courts look at historical data, usually taking a 3 to 5 year average of a professional's tax returns to establish a reliable baseline of their earning capacity. This works predictably when an individual's career trajectory is linear and expanding. However, when a recession strikes, historical data becomes an obsolete metric. An individual who earned a high consistent salary for the past 4 years may suddenly find themselves facing an overnight layoff, a corporate salary reduction, or the complete elimination of the discretionary bonuses and commissions that constituted the majority of their take-home pay. Let us explore a highly detailed scenario set in the turbulent economic landscape of 2026. Imagine a professional named Robert, who has spent the last decade working as a senior enterprise sales director for a major logistics corporation. His compensation structure is heavily weighted toward performance, consisting of a $90,000 base salary and an additional $160,000 in annual commissions tied to corporate shipping volumes and new client acquisitions. Based on his historical total income of $250,000, a family court judge orders Robert to pay a combined $4,500 per month in child support and temporary spousal maintenance to his estranged wife, Amanda, who has been out of the workforce for 7 years caring for their school-aged children. Suddenly, the macroeconomic environment of 2026 takes a sharp downturn. Global supply chains contract, industrial manufacturing slows down, and Robert's company experiences a massive drop in contract renewals. In response to the crisis, the corporation implements a firm-wide freeze on commissions and downscales its executive bonus pools. Robert's income instantly drops from his historical average down to his bare base salary of $90,000. After federal, state, and payroll taxes are deducted, his actual monthly take-home pay is roughly $5,500. Because he is legally bound by a pre-existing court order written before the economic shift, he is required to pay $4,500 of that remaining balance directly to Amanda. This leaves Robert with exactly $1,000 per month to cover his own rent, health insurance, utilities, and basic groceries, a situation that is mathematically impossible to sustain in a major American city. This scenario introduces the high-stakes legal battleground of imputed income and the modification process during an economic crisis. When Robert enters the family court system to request an emergency downward modification of his support obligations, he encounters a rigid legal standard known as a material and substantial change in circumstances. The burden of proof rests entirely on Robert's shoulders. In a recessionary environment, courts are flooded with similar requests, making judges inherently skeptical of sudden income drops. The court must determine whether Robert's income reduction is a legitimate, involuntary consequence of the macroeconomy or a calculated case of voluntary underemployment, where a paying spouse intentionally reduces their work hours, declines new contracts, or takes a lower-paying position simply to shrink their support liabilities. To navigate this successfully, a step-by-step evidentiary process is required. Robert cannot simply walk into a courtroom in 2026 and declare that business is slow. He must produce an exhaustive trail of corporate documentation. This includes official company-wide memos detailing the corporate restructuring, certified letters from human resources confirming the elimination of the commission structure, industry-specific economic data proving a sectoral downturn, and a detailed log of his ongoing efforts to maintain his sales pipeline despite the market contraction. If the documentation is deemed insufficient, the judge has the legal authority to impute income to Robert. This means the court legally treats Robert as if he is still earning $250,000, regardless of the physical reality of his bank account, based on his education, unique skills, and historical earning capacity. When income is imputed during a recession, a catastrophic financial spiral begins. Robert cannot pay the $4,500 per month, so he begins to accumulate what the legal system calls support arrears. Support arrears are a unique class of debt that cannot be discharged through bankruptcy proceedings. They accrue interest at statutory rates, which can be as high as 10% annually depending on the state jurisdiction. As the arrears mount over months of slow-moving legal proceedings, Robert faces severe statutory enforcement mechanisms, including the automated suspension of his driver's license, the revocation of his passport, the freezing of his personal bank accounts, and intercept orders placed on any potential tax refunds. This destruction of his personal credit and professional mobility further diminishes his ability to perform his job, compounding the income crisis. Now let us flip the perspective to analyze the equally devastating impact on the dependent spouse, Amanda. While Robert is struggling to survive on his base salary, Amanda is facing a parallel crisis driven by recessionary living costs and a tightening job market. The $4,500 she was awarded was calculated based on the cost of maintaining the marital household at the time of the initial separation. In a contracting economy, the cost of health insurance premiums, home utilities, and basic necessities rises sharply. Simultaneously, because the marital asset division has been delayed or trapped in real estate gridlock, Amanda has no liquid capital cushions to fall back on. If Robert's support payments suddenly drop or stop entirely due to his corporate downscaling, Amanda cannot simply re-enter the workforce to bridge the gap overnight. In 2026, widespread corporate hiring freezes mean that an individual who has been out of the job market for 7 years faces an immense structural hurdle. She is competing for entry-level positions against thousands of recently laid-off workers who possess current, uninterrupted specialized experience. The step-by-step reality of trying to secure employment during a recession involves navigating automated applicant tracking systems that frequently filter out individuals with significant employment gaps. Amanda finds herself in a precarious position where her primary source of financial survival is entirely volatile, while her path to self-sufficiency is blocked by macroeconomic barriers. To mitigate these extreme potential outcomes, sophisticated family law strategies during an economic downturn often pivot away from fixed-dollar support orders and toward flexible, tiered support structures. Historical trends indicate that rigid support numbers fail during recessions. Instead, forward-thinking legal professionals negotiate agreements that establish a modest, sustainable base support amount tied directly to the paying spouse's guaranteed base salary, combined with a strict percentage-based escalation clause for any future bonuses, commissions, or equity vestings that may occur if the market recovers. For example, the agreement might state that Robert pays a base amount from his $90,000 salary, but must automatically transfer a specified percentage of any gross commission income to Amanda within 10 days of receipt. This protects Robert from catastrophic arrears during the lowest points of the recession, while ensuring that Amanda automatically shares in the financial upside the moment Robert's industry begins to stabilize. Understanding the volatile mechanics of support modifications and income tracking is a critical pillar of surviving a recessionary split, but it represents only one facet of the structural changes couples face. When income streams, contract, and household budgets are pushed to their absolute limits, the strain does not stop at the balance sheet. It flows directly into the personal dynamics of the family structure, completely transforming how parents negotiate the care, scheduling, and long-term upbringing of their children. What happens when the financial pressure forces one parent to propose a radical relocation across the country just to secure employment? How do family courts handle custody schedules when parents are forced to work unpredictable, extended hours or multiple jobs just to stay afloat? In the next part of this masterclass, we will peel back the layers on the hidden operational crisis of child custody, scheduling conflicts, and parental relocation dynamics during an economic downturn. The intersection of parental rights and macroeconomic collapse creates a volatile environment where the daily logistics of child custody are fundamentally destabilized. In a prosperous economic cycle, custody schedules operate on a foundation of predictability. Parents have stable work hours, reliable childcare options, and the financial resources to maintain separate households without compromising the routine of their children. However, as we observe the economic realities of 2026, this predictability vanishes. Financial pressure forces parents to alter their employment structures, adjust their working hours, and make desperate career sacrifices simply to stay afloat. These professional shifts create a direct, immediate friction with existing custody orders, turning time-sharing agreements into a constant source of legal and personal warfare. Imagine a situation in 2026 involving a mother named Sarah and a father named Christopher, who share equal joint physical custody of their 2 middle school children in a suburb of Atlanta, Georgia. Their court-ordered schedule follows a traditional 2-2-3 rotation, requiring seamless cooperation and strict adherence to pick-up and drop-off times. Christopher, an industrial operations supervisor, suddenly faces a corporate downscaling. To avoid a complete layoff, he is forced to accept a mandatory shift modification, moving from a standard daylight schedule to an unpredictable rotating night shift that includes weekend coverage. Simultaneously, the manufacturing plant eliminates the administrative support staff, meaning Christopher must frequently stay late to handle logistical emergencies without prior notice. This sudden structural change completely destroys the viability of the 2-2-3 custody schedule. On a Tuesday afternoon when Christopher is legally obligated to pick up the children from school, he finds himself trapped on a production line miles away, unable to leave without risking immediate termination. Sarah is forced to disrupt her own professional schedule to handle the emergency pickup. If this pattern repeats over several months, a massive legal rift develops. Sarah files a petition to modify the custody arrangement, arguing that Christopher's career instability is detrimental to the children's routine and consistency. Christopher responds defensively, stating that his schedule modification is entirely involuntary and a direct consequence of the 2026 recessionary job market. When family courts evaluate these situations during an economic downturn, judges must navigate a delicate balance. On one hand, historical trends show that courts prioritize stability and continuity for the child. On the other hand, judges recognize that punishing a parent for adapting to a harsh economic environment can cause severe financial harm to the entire family unit. The court is forced to look at whether the parent is making a good faith effort to utilize family members, paid childcare, or flexible scheduling options to maintain their parental bond, or if the economic strain has rendered the existing custody order completely unworkable. Beyond the disruption of daily schedules, the microeconomy of the child's lifestyle becomes a battleground for cash-strapped parents. In a stable economy, expenses such as elite club sports, private tutoring, specialized summer camps, and private school tuitions are often divided proportionally between parents without significant dispute. In 2026, as household budgets contract under the weight of inflation and job insecurity, these extracurricular expenses transform into high-stakes financial liabilities. Consider a scenario where Sarah insists that their daughter must remain enrolled in a highly competitive, out-of-state travel soccer program that costs $8,000 annually, arguing that it is vital for her potential college athletic scholarships. Christopher, facing a 20% reduction in his take-home pay, views this expense as an unsustainable luxury. He refuses to contribute his 50% share, citing the clear language in their divorce agreement that requires mutual consent for non-essential extracurricular activities. This disagreement quickly escalates from a financial debate into a bitter custody dispute. Sarah accuses Christopher of abandoning their daughter's future, while Christopher accuses Sarah of using the child's activities to inflict financial distress upon him during an economic crisis. Family law courts in 2026 are increasingly forced to review these cases, step by step, analyzing whether an activity constitutes a necessary educational need or a discretionary luxury that must be paused until macroeconomic conditions improve. The most severe custody crisis triggered by an economic recession, however, is the parental relocation dilemma. When local job markets dry up, a parent may find that their only viable path to financial survival requires moving hundreds or thousands of miles away to a state or region where employment options are more resilient. If that parent is the primary physical custodian, or if they share equal joint custody, a relocation proposal acts as a legal grenade that threatens to sever the daily relationship between the child and the non-moving parent. Let us look at a case study of a software engineer named Jason living in a Midwestern tech hub in late 2026. Following his separation from his wife, Melissa, Jason is laid off as his firm downsizes its engineering department. For 6 months, Jason submits hundreds of applications locally but finds nothing but hiring freezes and salary offers that are 60% below his historical baseline. Finally, he secures a definitive, high-paying job offer in Austin, Texas, a region experiencing countercyclical growth. The offer requires him to relocate within 30 days. Jason files an emergency petition with the family court, requesting permission to relocate with their 7-year-old son, arguing that the move is an economic necessity that will ultimately benefit the child by securing housing, health insurance, and financial stability. Melissa immediately files an objection, triggering a high-conflict relocation hearing. The legal framework governing relocation during a recession is incredibly stringent. In the United States family law system, the moving parent carries a heavy burden of proof to demonstrate that the relocation is made in good faith, is driven by legitimate necessity, and is fundamentally in the best interests of the child. The court executes a rigorous multi-factor analysis. The judge examines the real-world availability of comparable employment within the local market, the specific salary differentials, the quality of the school systems in the new location, and the presence of extended family support networks. Most critically, the court evaluates the potential outcome of the move on the child's relationship with the non-relocating parent. If Jason is permitted to move the child to Texas, Melissa's weekly parenting time is completely eliminated. The court must determine whether a modified long-distance custody schedule, consisting of extended summer visits and major holiday rotations, can adequately preserve the parental bond. In a recessionary environment, this evaluation is further complicated by the cost of travel. If the court orders a long-distance schedule, the parents must incur the recurring expenses of cross-country flights, hotel accommodations, and travel logistics. When both parents are already financially strained, the cost of executing the custody schedule can become completely prohibitive. meaning a relocation order could effectively alienate a parent from their child's life due to sheer economic reality. These custody and relocation battles demonstrate that a recession does not merely threaten your bank account. It directly challenges the foundational structure of the American family unit. The psychological toll on parents who are simultaneously fighting for their financial survival and their parental rights is immense, often leading to a dangerous escalation of litigation tactics. As the financial pressure intensifies and the traditional paths to resolution become blocked by real estate stagnation, support disputes, and custody friction, the legal strategies utilized within the courtroom begin to shift toward extreme measures. Parents and their legal counsel are forced to adapt to a system that is slow, overburdened, and highly unpredictable. What happens when a spouse decides to weaponize the legal process itself, using deliberate delay tactics to drain your remaining financial reserves during a market bottom? How do you protect yourself when the cost of simply paying your attorney prevents you from saving your home or funding your custody dispute? In the next part of this masterclass, we will pull back the curtain on the hidden warfare of recessionary litigation tactics, examining how legal expenses are leveraged as strategic weapons and how to identify the warning signs of financial attrition before your resources are completely exhausted. When the macroeconomic environment contracts, the family courtroom frequently shifts from a venue of structured conflict resolution to an arena of absolute financial endurance. In a thriving economy, both parties typically have access to sufficient liquid capital, discretionary income, or open lines of credit to fund a high-stakes legal dispute. But in the current landscape of 2026, when liquidity evaporates and credit markets tighten, the wealthier spouse often identifies a brutal tactical advantage known as the strategy of legal attrition. This tactic involves intentionally inflating the cost of litigation to systematically exhaust the financial reserves of the less moneyed spouse, forcing them into a position of total economic vulnerability, where they are compelled to accept an unfavorable settlement simply because they can no longer afford to pay their legal counsel. Let us look closely at a scenario playing out in the current year of 2026 involving a couple named Michael and Emily. Michael is a senior partner at a commercial real estate consultancy firm, managing substantial marital assets but controlling the primary corporate bank accounts. Emily stepped away from her career a decade ago to raise their children and manage the household. As their marriage fractures amidst the 2026 economic downturn, Emily realizes she has zero access to independent capital. Her name is not on the corporate accounts. Their joint personal savings have been heavily depleted by recent stock market corrections, and her personal credit card limits have been tightly capped by banks managing their own recessionary risks. Michael's legal team understands this structural imbalance and initiates a systematic campaign of financial depletion. Step 1 of this attrition strategy involves drowning Emily in overbroad and exhaustive discovery demands. They issue formal requests for 10 years of detailed financial documentation, including personal diaries, bank statements from accounts closed long ago, receipts for every minor household purchase, and records of transactions that have no real bearing on the actual legal issues. To comply with these demands, Emily's attorney must spend dozens of billable hours reviewing, organizing, and drafting formal responses. Every single hour spent by her attorney drains Emily's initial retainer balance, pushing her closer to financial insolvency before a single temporary support hearing has even occurred. Once the initial retainer is exhausted, the strategy shifts to deliberate procedural obstruction. Emily's counsel schedules a mandatory deposition of Michael to uncover hidden corporate distributions and verify his true income streams. Preparing for a deposition requires intense, highly specialized billable legal preparation. However, less than 24 hours before the scheduled deposition, Michael's attorney files an emergency motion to adjourn, citing a sudden corporate crisis or an alleged scheduling conflict. The deposition is canceled, but the billable hours Emily's attorney spent preparing are permanently gone. When the deposition is finally rescheduled weeks later, the exact same process repeats, effectively doubling the legal expenses for a single procedural step. Simultaneously, Michael's team begins filing a continuous barrage of low-merit, aggressive motions over insignificant details. They might file a formal motion to compel discovery over a missing $500 receipt, or a motion to alter the specific drop-off location for the children by a distance of a few blocks. Under family court rules, Emily cannot simply ignore these filings. Her attorney must draft formal cross-motions, compile supporting affidavits, and attend court hearings to defend against them. Each court appearance requires hours of waiting in crowded, slow-moving recession-era courtrooms, causing her legal fees to spiral into tens of thousands of dollars. In a standard economic climate, the legal system provides a specific mechanism designed to prevent this exact type of abuse: a motion for interim attorney fees. This allows a judge to order the wealthier spouse to pay a lump sum directly to the less-moneyed spouse's attorney to ensure a level playing field. However, in 2026, the effectiveness of this remedy is deeply compromised by the macroeconomy. When Emily requests interim fees, Michael presents complex corporate balance sheets showing that his consulting firm has experienced a 70% drop in revenue due to the commercial real estate crash. He argues that his cash flow is completely frozen, his assets are illiquid, and he lacks the liquid funds to pay his own bills, let alone Emily's legal fees. Family court judges are forced to make decisions based on these highly opaque financial realities. If Michael's business genuinely appears capital-starved on paper because of the recession, the judge may hesitate to issue a significant fee-shifting order, fearing it could push the business into bankruptcy. Even if the judge grants a modest award, the enforcement of that order can take months of additional litigation. During this delay, Emily's attorney may be forced to file a motion to withdraw from the case due to non-payment. When an attorney withdraws during a high-conflict divorce, the unrepresented spouse is left entirely exposed, forced to navigate complex evidentiary hearings alone against a highly trained legal team. Historical trends from past market contractions show that legal attrition succeeds because it exploits the psychological and financial fatigue of the dependent spouse. The warning signs of this strategy are distinct and recognizable: a sudden refusal to negotiate in good faith during informal settlement conferences, an unprecedented increase in formal legal correspondence over trivial matters, and deliberate delays in producing standard financial disclosures that should take minutes to compile. The objective is not to win an argument on its legal merits, but to convert the divorce into a war of economic survival where the winner is determined solely by who runs out of money last. With traditional credit lines frozen, a growing number of individuals in 2026 turn to specialized third-party litigation funding companies to bankroll their legal battles. These firms operate similarly to venture capitalists, advancing capital to pay attorney fees in exchange for a percentage of the final marital property distribution. However, during a recession, these funding companies significantly tighten their underwriting criteria. They look at the marital asset pool with extreme scrutiny. If the primary asset is an underwater home or a declining private business, the funding company will view the risk as unacceptably high and deny the application, leaving the dependent spouse with absolutely no financial safety net. This structural warfare forces many cash-strapped couples to consider alternative dispute resolution methods, such as mediation or collaborative divorce. In a stable economy, these pathways offer a streamlined, cost-effective route to closure. But during a recession, even alternative dispute resolution undergoes a dangerous shift. Mediation requires both parties to enter negotiations with a mutual baseline of trust and transparent disclosure. If one spouse is actively using the economic downturn to hide assets or mask their true earning capacity, mediation becomes a trap. The vulnerable spouse may agree to an unconscionable settlement during mediation, simply to stop the financial bleeding of litigation, giving up long-term security in exchange for immediate relief from the crushing pressure of mounting legal bills. The weaponization of legal fees and the execution of attrition strategies demonstrate that the financial damage of a recessionary divorce extends far beyond the division of physical assets. It infiltrates the very mechanics of the legal process itself, turning the pursuit of equity into a costly trap for the unprepared. But surviving the courtroom battle is only the first step of the gauntlet. Once the litigation concludes and the final signatures are placed on the divorce decree, a completely new and highly complex financial reality emerges. How do you restructure your life when the tax codes, debt obligations, and government regulations of a recessionary economy collide with your newly finalized settlement? What happens when hidden tax liabilities, tied to liquidated retirement accounts or depreciated property transfers, suddenly surface to decimate your remaining capital? In the next part of this masterclass, we will unlock the hidden financial aftermath of the divorce journey, examining the critical tax traps, structural debt liabilities, and credit rebuilding strategies that define post-divorce survival during an economic crisis. The final signature on a divorce decree in the year 2026 does not signal the end of the financial gauntlet. Rather, it marks the transition into a complex post-separation economy, where hidden tax liabilities and structural debt traps can quietly dismantle your remaining wealth. In a standard economic climate, executing the post-divorce division of accounts and moving into separate financial lives is a procedural formality. But during a major macroeconomic contraction, the tax codes and credit markets become inherently hostile. Mistakes made during the immediate aftermath of a split can trigger irreversible financial penalties, unexpected IRS liabilities, and a catastrophic collapse of your personal credit profile at the exact moment you need financial flexibility the most. To fully grasp the magnitude of these hidden dangers, let us dissect the portfolio liquidation trap through a highly realistic scenario in 2026 involving a recently divorced individual named Brian. As part of his marital settlement, Brian is awarded a 50% share of his ex-spouse's corporate 401k retirement account, totaling $200,000. The transfer is executed correctly via a qualified domestic relations order, which allows the funds to move from one spouse to the other without triggering an immediate tax event. However, because the 2026 recession has caused Brian's primary business income to drop significantly, he finds himself facing an immediate liquidity crisis. He needs cash to secure a new rental lease, pay moving expenses, and cover outstanding legal bills. Brian decides to withdraw $100,000 from his newly established retirement account, assuming that since the money came from a divorce settlement, he is protected. This is a massive mistake. Under Internal Revenue Code Section 72T, there is a highly specific exception that waives the 10% early withdrawal penalty for distributions taken directly from a qualified plan pursuant to a qualified domestic relations order, before the funds are rolled over into an individual retirement account. However, while Brian might avoid the 10% penalty if he structures the withdrawal perfectly at the time of the initial distribution, the entire $100,000 is still treated as ordinary income. In 2026, when Brian files his federal tax return, this sudden influx of paper income pushes him into a significantly higher tax bracket. Furthermore, because corporate retirement plans are legally mandated to automatically withhold 20% for federal income taxes at the time of a cash distribution, Brian only receives $80,000 in cash, while his total tax liability at the end of the year far exceeds that amount based on his adjusted gross income. Historical trends demonstrate that individuals who liquidate retirement assets out of desperation during an economic downturn frequently trade short-term liquidity for a crushing long-term tax debt that cripples their recovery. A parallel vulnerability emerges when analyzing the carryover basis rule under Internal Revenue Code Section 1041. Property transfers between spouses that are incident to a divorce are generally non-taxable at the moment of the transfer. However, the spouse receiving the asset also inherits the historical cost basis of that asset. Imagine a scenario in 2026 where a spouse named Lisa receives a non-retirement investment brokerage account valued at $150,000, while her ex-spouse retains an equal amount in cash savings. The stocks within Lisa's new portfolio were originally purchased a decade ago for $30,000. Because the macroeconomy is contracting in 2026, Lisa needs to liquidate a portion of these stocks to cover her rising daily living expenses. The moment she sells the shares, she triggers a massive capital gains tax liability based on the appreciation from the original $30,000 purchase price, not the value on the day she received the account. Her perceived $150,000 asset is instantly devalued by thousands of dollars in federal and state capital gains taxes. Case studies from past recessions highlight how a failure to calculate the embedded tax liabilities of transferred assets results in an inherently unequal distribution of wealth, leaving one spouse with tax-free liquidity and the other with a heavy tax burden. Beyond the realm of taxation, the structural breakdown of joint debt obligations represents a major point of failure for post-divorce survival during an economic crisis. Let us look at a detailed case study of a couple named Mark and Karen, whose 2026 divorce decree explicitly states that Karen is solely responsible for paying off a joint credit card line with a balance of $30,000, as well as an outstanding joint auto loan on her primary vehicle. The decree includes a standard indemnification clause, stating that Karen must protect Mark from any financial harm related to those specific debts. 2 months after the divorce is finalized, the recession worsens, and Karen is placed on an involuntary corporate furlough. Her income drops to zero, and she stops making payments on the credit card and the auto loan. Mark assumes he is entirely safe because the state family court judge signed the divorce decree allocating those debts to Karen. This is an absolute misconception that destroys thousands of credit profiles during every economic contraction. Third-party creditors, such as major national banks and auto lenders, are completely independent entities. They are not parties to the divorce lawsuit, and they are not bound by a state family court decree. The original contract signed by both Mark and Karen remains fully enforceable under commercial law. The moment Karen defaults, the automated credit reporting systems of the financial institutions flag both accounts as delinquent. Mark's credit score immediately drops by more than 100 points, severely limiting his ability to secure housing, obtain insurance, or qualify for independent financing in the tight credit market of 2026. When Mark contacts the lenders to present his divorce decree, the customer service algorithms and legal departments flatly inform him that he remains jointly and severally liable for the balance. To protect his credit from total destruction, Mark is forced to use his own dwindling liquid reserves to pay the past due balances on Karen's debts. His only legal recourse is to hire an attorney, return to the family court, and file a formal motion for contempt to enforce the indemnification clause. In a recessionary legal system, this enforcement process can take months and cost thousands of dollars in additional legal fees, with no guarantee that Karen will have the physical funds to reimburse him once the judge issues an order. Navigating this hostile environment requires a strict, step-by-step credit insulation strategy that must be executed immediately following a separation. First, you must systematically close all joint credit lines or convert them to individual accounts, ensuring that no new charges can be incurred by an ex-spouse during a period of financial distress. Second, if a joint auto loan or mortgage cannot be refinanced immediately due to tight lending standards, the divorce agreement must be structured to require an immediate sale of the asset, rather than relying on an unprovable promise to pay. Third, individuals must utilize specialized credit monitoring tools to track any changes to their public records or credit utilization metrics, allowing them to identify the early warning signs of an ex-spouse financial default before the damage becomes irreversible. The economic contraction of 2026 also intensifies the battle over federal tax dependency exemptions and the child tax credit. Parents frequently clash over who has the legal right to claim their children on their annual tax returns because that designation provides direct, liquid tax relief. Under strict IRS rules, the primary custodial parent, the parent with whom the child resides for the greater number of nights during the calendar year, is automatically entitled to the dependency benefits. The non-custodial parent can only claim the child if the custodial parent executes IRS Form 8332, which formally waives their right to exemption for a specific tax year. During a recession, a non-custodial parent who is facing a massive tax bill due to reduced deductions may desperately demand that Form 8332 be signed, while the custodial parent refuses out of their own financial need or personal retaliation. This disagreement regularly forces cash-strapped parents back into court over an issue that a stable economy usually resolves through simple compromise. Managing the post-separation landscape during an economic crisis requires moving away from emotional decision-making and adopting a highly disciplined approach to risk mitigation. You must analyze every asset transfer, every joint liability, and every tax designation through the lens of a contracting economy where cash is scarce and credit is a luxury. But the vulnerabilities of your new life do not stop at tax filings and debt collections. There is an even more volatile, unpredictable risk factor that can completely erase your financial security overnight, a threat tied directly to the structural protection of your ongoing support systems. What happens when your ex-spouse suddenly suffers a complete medical emergency, loses their employer-sponsored health insurance, or passes away without a properly structured life insurance trust to guarantee your future alimony and child support payments? In the next part of this masterclass, we will expose the hidden operational failures of post-divorce insurance gaps, health coverage disruptions, and estate planning vulnerabilities during a macroeconomic recession. When an individual navigates the finality of a divorce during an economic downturn, they often overlook the fragile infrastructure that keeps their daily health and financial security intact. While managing real estate debts, restructuring investment portfolios, and adjusting support payments dominate the legal conversation, an equally devastating set of traps forms within post-divorce insurance gaps, health coverage disruptions, and outdated estate planning documents. In the current economic environment of 2026, these operational failures can erase decades of financial planning overnight. The systems that protect your physical health and secure your future support are highly sensitive to macroeconomic shocks, meaning that a single administrative omission or a failure to anticipate an ex-spouse financial insolvency can leave you completely exposed to catastrophic risk. To fully comprehend the immediate dangers of health insurance disruption, let us look at a highly realistic scenario in 2026 involving a recently divorced individual named Sandra. Throughout her 12-year marriage, Sandra was covered under a high-tier health insurance policy provided by her ex-husband Mark's corporate employer. Sandra suffers from a chronic health condition that requires ongoing, specialized medical treatments and expensive prescription medications. When the divorce decree is finalized in mid-2026, Sandra is legally stripped of her status as a dependent on Mark's employer-sponsored plan. To maintain continuity of care, Sandra relies on the Consolidated Omnibus Budget Reconciliation Act, commonly known as COBRA, which allows a divorced spouse to temporarily maintain coverage under the group health plan for up to 36 months. However, the step-by-step reality of executing COBRA during a recession introduces a massive financial shock. Under normal circumstances, an employer heavily subsidizes the monthly premium for its active workers. When an ex-spouse transitions to COBRA, that subsidy completely evaporates. Sandra is now legally responsible for paying the entire gross premium, plus an additional 2% administrative fee. In the tight economic climate of 2026, corporate insurance premiums have surged. Sandra discovers that her new monthly premium for a single policy is nearly $1,200, an amount that consumes a massive portion of her monthly spousal maintenance. The potential outcomes worsen significantly when the macroeconomy forces Mark's employer into corporate restructuring. 2 months into Sandra's COBRA coverage, Mark's company faces a severe revenue contraction and implements a firm-wide reduction in workforce, laying Mark off entirely. The moment Mark is terminated, the company's group health insurance plan is completely shut down for that tier of employees, or the corporation may dissolve entirely. Because COBRA is merely a statutory extension of an existing group plan, the complete termination of the employer's plan means Sandra's COBRA coverage vanishes instantly into thin air. Sandra is thrown into an immediate health crisis, forced to navigate the public health insurance marketplace during a period of peak economic instability, where her pre-existing medical conditions require her to accept a plan with significantly higher deductibles and a completely different network of approved physicians. While managing a sudden health insurance crisis can compromise your daily survival, a parallel vulnerability occurs when a recessionary cash crunch causes the collapse of life insurance policies designed to secure ongoing support. Standard family law practice dictates that when a court orders child support or alimony, the payer spouse must maintain a life insurance policy equal to the total net present value of those future financial obligations, naming the recipient spouse or a child trust as the irrevocable beneficiary. This ensures that if the payer passes away unexpectedly, the family is not left completely destitute. In the current year of 2026, historical trends indicate that when households face severe cash flow restrictions, individuals begin prioritizing their immediate daily expenses over long-term insurance premiums. Consider a case study involving a payer named John, who is legally obligated to maintain a $500,000 term life insurance policy to secure his ongoing child support payments to his ex-wife, Rachel. As the recession deepens, John's independent consulting business experiences a severe drop in client contracts. Looking to cut monthly expenses, John decides to stop paying the premiums on his private life insurance policy, assuming he can reinstate the coverage once the economy recovers. Because John is the absolute owner of the policy, the insurance company sends the late payment notices and grace period warnings exclusively to his private address. Rachel has no legal right to view the account status and remains entirely unaware that the policy is in jeopardy. The grace period expires, and the policy completely lapses. If John suffers a fatal medical emergency or a catastrophic accident during this period of lapsed coverage, Rachel is left in a position of total financial ruin. The ongoing child support payments stop instantly, and her only legal remedy is to file an unsecured claim against John's estate. In a recession, John's estate is likely burdened by liabilities, negative equity, and outstanding corporate debts, meaning Rachel will receive pennies on the dollar after years of slow, expensive probate litigation. To prevent this specific operational failure, a precise step-by-step structural change must be implemented during the initial divorce drafting phase. Sophisticated legal strategies avoid leaving policy ownership in the hands of the payer spouse. Instead, the final agreement should mandate that the recipient spouse, Rachel, be designated as the absolute owner of the policy, while John is legally ordered to fund the premiums by transferring the necessary capital directly to her, or having the premiums drafted from a joint escrow account. As the owner of the policy, Rachel receives all premium statements, cancellation warnings, and lapse notices directly from the insurance carrier. If John fails to provide the funds, Rachel can choose to pay the premium herself to preserve the coverage and immediately haul John back into family court for a contempt violation, preventing a silent lapse from destroying her long-term security. The complexity multiplies exponentially when we shift our focus to estate planning vulnerabilities and the distribution of wealth after a split. A dangerous misconception shared by many American citizens is the belief that a finalized divorce decree automatically revokes an ex-spouse's right to inherit assets. While many state jurisdictions possess statutory laws that automatically disqualify an ex-spouse from a standard will or a state-regulated insurance policy upon the entry of a final divorce judgment, these state laws are entirely powerless when they collide with federal statutes. This introduces the critical legal doctrine of federal preemption under the Employee Retirement Income Security Act, widely known as ERISA. Federally regulated employee benefit plans, which encompass the vast majority of corporate 401k accounts, employer-provided group life insurance policies, and enterprise pension structures, are strictly governed by federal law, not state family law. Case studies from past economic downturns reveal devastating scenarios where a divorced professional passes away during a recession without ever submitting a physical beneficiary change form to their corporate plan administrator. Even if their state level will explicitly disinherits the ex-spouse, and even if the final signed divorce decree contains an explicit waiver where both parties give up all claims to each other's retirement funds, the federal plan administrator is legally required to distribute the entire asset pool directly to the beneficiary listed on the official company form. The ex-spouse walks away with the entire corporate portfolio, while the surviving children or family members are left with absolutely nothing, their legal challenges dismissed by federal courts bound by strict ERISA compliance. Surviving the aftermath of a recessionary split requires a meticulous, systematic audit of every administrative link in your financial chain. You must treat every insurance policy, every healthcare transition, and every beneficiary designation as a potential point of failure that requires proactive management. But safeguarding your infrastructure against insurance lapses and federal preemption traps is only half of the battle. In a contracting economy, the actual governmental and institutional machinery, designed to process your paperwork, resolve your remaining disputes, and enforce your hard-fought court orders is experiencing its own severe operational crisis. What happens when you execute every strategy perfectly, but the family court system itself faces historic backlogs that delay your hearings for over a year? How do you handle an environment where state child support enforcement agencies are understaffed, underfunded, and completely incapable of pursuing non-compliant ex-spouses? In the next part of this masterclass, we will pull back the curtain on the institutional breakdown of the family law system during an economic contraction, exploring the tactical pathways required to bypass court gridlock, handle an overwhelmed judiciary, and utilize private enforcement mechanisms to secure your family when the traditional legal machinery completely grinds to a halt. The institutional framework of the American family law system is not insulated from macroeconomic shocks. Rather, it often bears the full weight of the societal chaos triggered by a recession. In a stable economy, the administrative machinery of state court systems operates with a baseline level of efficiency. Timelines for hearings are predictable, court staff are fully funded, and judicial resources are sufficient to manage the standard flow of domestic relations filings. However, as we observe the structural realities of the current year 2026, a major economic downturn fundamentally destabilizes this infrastructure. A contraction in the economy creates a devastating operational paradox. Just as state budget deficits force severe funding cuts and staffing reductions within the judiciary, the volume of emergency filings spikes exponentially, leading to complete institutional gridlock. To understand the mechanics of this system failure, we must analyze how state revenues directly dictate the speed of your legal journey. When a recession takes hold, state governments experience a sharp decline in sales taxes, corporate tax revenues, and income tax collections. To balance their budgets, state legislatures implement sweeping fiscal reductions across all branches of government, frequently targeting the operating budgets of the state judiciary. In 2026, this translates to concrete operational limitations. Court clerk offices reduce their operating hours, electronic filing maintenance is delayed, court reporters and administrative assistants face widespread furloughs, and vacant judicial seats remain entirely unfilled. Concurrently, the demand for judicial intervention reaches historic peaks. Tens of thousands of citizens who have recently lost their corporate positions, experienced business failures, or suffered asset contractions flood the clerk's offices with emergency motions for downward child support modifications, alimony reductions, and enforcement petitions against defaulting ex-spouses. This massive imbalance between shrinking court capacity and expanding case volumes creates a profound structural backlog, stretching the timeline to resolve even basic family law motions from a few weeks into many months or even years. Imagine a situation in 2026 involving a public citizen named Kevin, who resides in a major metropolitan county that has been heavily hit by industrial downscaling. Kevin's commercial contracting firm has experienced a 70% reduction in project bookings, forcing him to sharply lower his personal draw to keep his business from insolvency. His existing temporary support order, established during a market peak 2 years prior, requires him to pay a substantial monthly sum that is now completely mathematically impossible to satisfy. Kevin's legal counsel drafts a comprehensive motion for a downward modification, backed by certified accounting data, and files it with the court, expecting an urgent hearing before a judge. Instead of a swift resolution, Kevin is informed by the court administration that due to the extreme recessionary backlog and a severe shortage of family law magistrates, his motion cannot be heard for another 9 months. During this long waiting period, the pre-existing, obsolete support order remains fully active and legally binding. He is trapped in a position where he must either deplete his remaining corporate emergency reserves to satisfy an unrealistic order or stop paying and allow substantial, non-dischargeable support arrears to accumulate against his name. This scenario highlights how institutional delays directly amplify the personal financial crises of individuals navigating a split during an economic downturn. When an individual finally survives the months of administrative delay and secures a day in court, they encounter the next major obstacle: the overwhelmed judiciary. In 2026, family court judges are managing severely overloaded dockets, frequently tasked with hearing 40 to 50 separate domestic relations matters in a single morning session. A complex financial dispute involving asset depreciation, hidden corporate distributions, and the imputation of earning capacity requires a meticulous, step-by-step review of detailed forensic evidence and tax documentation. Yet, the physical constraints of an overpopulated court schedule mean that the judge may only have 10 to 15 minutes to allocate to each case before moving to the next file. In this fast-paced, high-stress courtroom environment, judges are often forced to abandon deep analytical reviews. Instead, they frequently rely on broad, standardized mathematical formulas, temporary status quo extensions, or rapid-fire, arbitrary rulings designed simply to clear the calendar. The potential outcomes of these rushed judicial decisions are highly volatile. An individual may walk away with a support obligation or a property division order that completely miscalculates their true economic capacity, forcing them back into the legal system to appeal a flawed judgment, which triggers a new cycle of expensive, slow-moving litigation. To bypass this institutional breakdown and protect their financial futures from the dangers of a rushed judiciary, a growing number of sophisticated litigants in 2026 are completely altering their legal strategies, turning toward private dispute resolution mechanisms such as private judging and binding family law arbitration. In state jurisdictions where this is legally permissible, couples can contractually agree to opt out of the public court system entirely. They collectively hire a retired family law judge or a highly specialized matrimonial attorney to act as a private arbitrator, vesting them with the legal authority to issue binding rulings that are subsequently confirmed by a state court judge. The step-by-step execution of a private arbitration proceeding offers a stark contrast to the public court machine. The parties agree on the specific arbitrator, divide their hourly fee, and schedule comprehensive hearings in a private conference room. Unlike the public system, the private arbitrator has the time and focus to review hundreds of pages of forensic accounting audits, analyze volatile corporate balance sheets under recessionary pressure, and dedicate consecutive, uninterrupted days to a single family's dispute. While the upfront cost of funding a private judge is substantial, historical trends indicate that this strategy frequently saves couples tens of thousands of dollars in long-term legal costs by compressing a multi-year public court battle into a matter of weeks, completely neutralizing the weapon of legal attrition. The structural gridlock of a recessionary economy also severely compromises the functionality of state child support enforcement agencies. These government offices are responsible for tracking non-paying parents, intercepting tax refunds, and executing wage garnishments for millions of families. During a market contraction, as defaults rise and corporate payroll departments become understaffed, these enforcement agencies face a tidal wave of new collection cases just as their own operational budgets are frozen. A custodial parent relying on a state agency to enforce a vital support order in 2026 may find that their case sits untouched in an automated queue for half a year, leaving them without the liquid cash required to maintain housing or pay utilities. To survive this breakdown of state enforcement, parents are increasingly forced to utilize private enforcement mechanisms. This process involves bypassing government agencies and directly retaining private collection attorneys who possess the specialized skills to execute independent, aggressive collection tactics. These private professionals can independently subpoena bank records, place judicial liens on real estate holdings, initiate formal foreclosure proceedings on marital property to satisfy support debts, and execute third-party garnishment against independent contracting income. By utilizing private enforcement, a custodial parent takes direct control of the timeline, ensuring that their family's survival is not held hostage by a failing bureaucratic system. Navigating the institutional collapse of the legal system during an economic crisis requires an absolute abandonment of traditional, passive legal playbooks. You cannot afford to wait for a broken public machine to deliver equity or resolve your conflicts. You must treat the court system itself as a highly volatile variable that requires strategic management, active circumvention, and the utilization of private, controlled pathways to achieve a secure resolution. But understanding how to navigate court gridlock, handle an overwhelmed judge, and enforce your rights through private means represents the final operational bridge of this journey. Once you have mastered the real estate traps, the asset valuation schemes, the support modifications, the insurance gaps, and the institutional backlogs, you must assemble these pieces into a singular cohesive blueprint for long-term survival. How do you synthesize all of these tactical insights into a definitive step-by-step checklist to protect your wealth, your children, and your emotional stability as the economic storm continues to rage? In the final 10th part of this Masterclass Master Series, we will deliver the ultimate Masterclass roadmap, providing you with the exact protective blueprint and recovery strategies required to emerge from a recessionary divorce with your financial sovereignty completely intact. To achieve this level of complete financial sovereignty, you must transition from a defensive posture into the systematic execution of a multi-phase stabilization blueprint. This final masterclass roadmap synthesizes every economic and legal variable we have analyzed into a precise, operational checklist designed to mitigate risk and preserve capital during the 2026 market contraction. When the macroeconomic environment is unstable, you cannot rely on generalized legal advice or emotional intuition. Survival requires a cold, mathematical approach to restructuring your personal and professional life. By executing this blueprint step by step, you position yourself to weather the immediate crisis and lay the foundation for long-term recovery when the broader economy eventually stabilizes. Phase 1 of this blueprint requires an immediate, comprehensive financial triage. Before initiating any formal legal discussions or filing paperwork in 2026, you must establish an absolute baseline of your true marital estate. This involves compiling an exhaustive, encrypted digital repository of every asset, liability, corporate distribution, and income stream tied to both parties. You must secure 5 years of complete federal and state tax returns, including all schedules, W-2 forms, and 1099 statements. If a private business is involved, you must obtain general ledgers, corporate bank statements, profit and loss sheets, and balance sheets reflecting current recessionary performance metrics. Simultaneously, you must secure current statements for all retirement portfolios, brokerage accounts, mortgage balances, and consumer debt lines. Imagine a scenario in 2026 involving a professional named James and his spouse Eleanor. James recognizes that his marriage is failing amidst widespread layoffs in his industrial sector. Instead of rushing to file a standard petition, James spends 3 weeks quietly executing phase 1 of the blueprint. He downloads every financial statement, identifies 2 hidden margin accounts tied to their joint brokerage portfolio, and tracks a sudden drop in the reported revenue of Eleanor's boutique marketing agency. By securing this data before formal litigation alerts Eleanor, James prevents the destruction or concealment of critical financial evidence, ensuring that future valuation models are built on real-world data rather than manufactured recessionary distress. Phase 2 focuses on tactical liquidity management and the avoidance of catastrophic tax traps. In a contracting economy, liquid cash is your primary defensive shield, but acquiring that cash through improper means can lead to severe institutional penalties. The blueprint dictates that you must preserve your existing cash reserves by cutting all discretionary household expenditures and establishing independent, individual bank accounts at entirely separate financial institutions. This prevents a hostile spouse from freezing joint operating capital during a legal dispute. If you must access funds from non-retirement investment accounts, you must calculate the exact carryover basis under Internal Revenue Code Section 1041 to avoid inheriting massive capital gains liabilities. If retirement asset liquidation is the only viable path to cover legal expenses, you must work with a certified specialist to structure the distribution directly through a qualified domestic relations order prior to any individual account rollover, minimizing exposure to early withdrawal penalties under Section 72T, while factoring the increased ordinary income tax bracket adjustments into your 2026 filing strategy. Phase 3 requires the implementation of structural negotiation frameworks that adapt to income volatility and asset depreciation. Historical trends reveal that rigid, fixed-dollar settlements fail during economic downturns, pushing families into endless modification cycles. The blueprint mandates the utilization of tiered support structures and in-kind asset divisions. When calculating alimony or child support in 2026, your legal agreements must establish a sustainable base support figure tied to a verified base salary, combined with a strict, percentage-based escalation clause governing any future bonuses, corporate commissions, or equity vestings. When dividing shrinking investment portfolios or volatile stock options, you must reject arbitrary cash-out offers based on temporary market bottoms. Instead, you must insist on an in-kind division, dividing the actual number of shares or fractional options proportionally. This approach ensures that both parties absorb an equal share of immediate market risk, while retaining an equal share of the financial upside when the macroeconomic cycle rebounds. Phase 4 addresses the circumvention of institutional court gridlock through private dispute resolution. If you rely on the overburdened public family court system in 2026, your case can sit unresolved for months, draining your capital through continuous attorney retainers while obsolete support orders remain active. The blueprint dictates that you must proactively propose the utilization of private judging or binding family law arbitration. By contractually opting out of the public docket, you select a dedicated, specialized professional who possesses the time and operational focus to analyze complex forensic data, review deflated private business valuations, and issue binding rulings within a compressed time frame. This strategy effectively neutralizes the weapon of legal attrition, preventing a wealthier spouse from using calculated procedural delays to force an unconscionable settlement. Phase 5 involves the immediate post-decree infrastructure lockdown to insulate your new financial identity from third-party liabilities and administrative errors. The moment the final divorce decree is signed by a judge, a critical 24-hour timeline begins. First, you must submit formal certified copies of the decree to all human resource departments and plan administrators to officially update your beneficiary designations on all corporate 401k plans, group life insurance policies, and pension plans. This step is vital to override federal preemption traps under the Employee Retirement Income Security Act, ensuring that an ex-spouse cannot legally claim your estate if an unexpected emergency occurs. Second, you must systematically close all joint consumer credit lines, credit cards, and home equity lines, obtaining formal written confirmation from lenders that your name has been entirely detached from the debt contracts. If joint auto loans or mortgages remain open pending a future refinance or sale, you must establish an automated monitoring protocol to track payment histories, allowing you to intervene and protect your personal credit score before an ex-spouse default triggers automated reporting penalties. Case studies of individuals who have successfully navigated major American recessions show that the line between total insolvency and financial independence is determined entirely by the willingness to abandon emotional narratives and embrace structural discipline. Those who approach a split as a legal battle over blame frequently exhaust their resources on billable litigation fees, leaving both parties destitute at the bottom of a market cycle. Conversely, those who treat the transition as a complex corporate restructuring project utilize the mechanisms of forensic auditing, flexible support tiering, and private arbitration to insulate their capital from macroeconomic volatility. The potential outcomes of executing this comprehensive blueprint are clear. You eliminate the fear of the unknown by replacing speculation with empirical data. You strip away the tactical advantages of an aggressive opponent by neutralizing the paths to financial attrition and debt camouflage. Most importantly, you secure the physical health and daily consistency of your children by structuring custody schedules and support mechanisms that are resilient to career disruptions, corporate downscalings, and regional relocations. The current economic downturn of 2026 introduces unprecedented structural challenges to the family law system, but for the prepared individual, it also represents a unique historical window to execute a clean, equitable separation that protects your personal sovereignty. This concludes our 10-part deep dive masterclass series on navigating the changing aspects of the divorce journey during economic recessions. While you now possess the precise tactical frameworks required to survive the courtroom and secure your assets during a market contraction, the journey toward complete wealth generation and personal independence in the post-crisis era is just beginning. When the legal dust settles and your separate financial identity is fully established, you enter a completely new macroeconomic landscape filled with hidden opportunities for long-term compounding, strategic asset acquisition, and advanced estate planning. In our upcoming masterclass series, we are going to pivot directly into the mechanics of post-divorce wealth accumulation, exposing the exact methodologies utilized by high-net-worth individuals to rebuild their credit profiles, identify countercyclical investment opportunities, and establish generational legacy trusts while the broader economy begins its eventual ascent.